Right, welcome everybody. We're delighted to welcome back Tony Steels, the CEO, and Will Wilkins, the Group Finance Director of Mpac Group. And they are here to talk about their results for 2018 that were released this morning, and also where that leaves them looking to the future and the execution of their turnaround plan. So, Tony, you must be a happy man. Good set of numbers, and particularly a good second half.
To describe me as a happy man is probably stretching a little bit. Andy,
You're smiling. You're smiling.
No, I think we made really good progress last year. You look at the order book is a record high for the business since the divestment of the instrumentation and tobacco machinery. The order intake was again growth, and the sales were a growth. So in terms of strategic intent, we're on track for growth. We're 50% bigger than we were when we divested of the instrumentation tobacco business a year ago.
Yeah, it's amazing how quickly it's all moved on from there.
Yeah, we're now a fully focused company on the packaging machinery in the healthcare, pharmaceutical, food and beverage areas, and it's really the marketplace where we can exploit our embedded customer relationships.
And we talked about the comparison between first and second half. It was a historic or a legacy problem and contract situation that held you back at the half-year stage. Is that all signed, sealed and consigned to the past now?
They are. As far as we can see, we've absolutely closed one off. We've got a contractual agreement with the customer, and that's now closed and finalised. The other one, we've still got some work to do, and that's scheduled for completion in the quarter 3 of this year. But the costs are all contained in 2018. And as a mark of the improving relationship with that customer, we've won several new contracts since.
For the same customer?
For the same customer since we had those issues last year. So I think we're really back on a positive track. And we've done an awful lot of work to look through the order book to make sure the engineering concepts are sound, and that the projects are deliverable in terms of timescale and margin. So we're confident going into 2019 that the order book is in good shape and well placed to deliver on some good results.
Yeah. And for those of the watchers who don't know your business too well, you've mentioned a focus on specific sectors. Do you want to say a little bit more about why you have that focus, what those markets are doing, what the outlook is, and obviously why Mpac has an opportunity to perform well in that specific segment?
Yeah, sure. Well, we took the decision to focus on healthcare, pharmaceutical, food and beverage. And why? Because they are global markets. Huge markets, $40 billion market for packaging machinery per annum, and we're a relatively small company, so we see growth opportunity over many years. The fundamental growth drivers behind those markets, macroeconomic drivers, if you like, are there. They're sound, forecasting 4 to 5% growth per annum. So we're targeting double that. Why? Because of our size and scale compared with the size of the market opportunity. The markets themselves are markets we've got good expertise, good knowledge, know-how, and an excellent portfolio of products to exploit the opportunities. So it's all about building up our opportunities with our existing customers and winning over new customers, acquiring new customers in the adjacent markets. Okay.
And that 40 billion global market, how is that spread in terms of continental or country diversity, and how is Mpac aligned to match that market?
Well, it's pretty evenly spread. It's about a third across the Americas, across EMEA and across Asia. So it's very much a global market. A lot of our customers are global customers. We have got already a global reach to the customers. We have a business in Canada, which is over 100 people. We have a business in Holland, 150 or so people. In the UK, in Singapore, we have a sales and service office. This year, we are prioritising the sales team in the USA market. That's one of our main drivers. Why? Because the USA market is really a vast market, big opportunities there, and managing that from Canada is, I think is a limit at the moment, and we need to bring more direct people into the USA market. So we're focusing on that, and we're also focusing on Asia to try and leverage more our customer relationships there and grow the market more in Asia. One of our other objectives there is to work with a low-cost manufacturing supply chain to bring a product to the Asian market that is at a lower price point to open up a bigger market opportunity for us.
Mm-hmm. I'm intrigued by the focus on US sales. Is that going to involve regional offices, or is it going to be through partnerships?
Well, we've always had salespeople and service people in the US market, but it is such a vast market. I think the customers would appreciate having closer contact. So the first phase of that is to improve the sales coverage, which we're already underway. And then the second phase will be to improve the service coverage, and that may well then turn out to be an office location somewhere in the US. But the first phase is to build up the resources on the ground and make sure that they're onboarded and fully equipped to promote the Mpac product range across that market.
And is it easy to recruit high quality people at the moment? What's the perception of Mpac in the market, and are people seeing it on the up compared to competitors?
It's never easy to recruit talent because there's other people always up against you and competing for the same talent. But I think we've got a really compelling business case. We've relaunched the business 2 years ago. We've got a new name, new brand, new market mission statement in terms of the full solution, and a new set of clothes with the Mpac branding. So we launched the Chicago show last year in the US, and that created an awful lot of positivity, which we hope to build on. So we feel quite confident we can bring the right people into the company, but it's always a competitive environment.
Mm-hmm. And what has happened to the headcount in the course of the last year? It sounds like there's quite a lot going on, so I assume it's grown.
It has increased. It's increased by around about 100 employees, and that's mainly in service, in assembly, in engineering. So these are all what we would term direct costs, so they're the scalable costs with the business. In order to accommodate the growth that we see and to make sure that we're well resourced for the growth that we foresee in 2019 and beyond.
Okay. And in terms of the focus that you've brought to the group, we've talked about the markets and how you're addressing them. What about talking a little bit about the concepts of getting, well, first of all, getting in early with a client or a potential client at I think you call it the pre-solution stage.
Yeah. Well, one of the real targets for us is to be there at the inception of a new idea, a new packaging solution. We have a business in Coventry in the UK, which is really geared up for that first of a kind concept proving type solution for a customer. So if the marketing department of a big fast moving consumer goods company comes with a new idea, we really want to encourage that conversation with our Coventry business to make sure that we can help them to find the right solution. Once we've done that, we would then move that into the other parts of the business for larger scale machine production. So it's an important part of what we do, but equally important is just staying close with our existing customers on their innovation and what they're trying to do with their machinery and equipment today. And Industry 4.0, which I think is a term being used an awful lot at the moment, that's really important for us with the data management and the automation of our machines, to be able to use all that data, to be able to work with the customer and give immediate feedback on the condition monitoring of the machine to maximise the efficiencies. So that's an area where we really want to work and develop with our customer base and our innovation team this year.
And how directly involved might a very large customer be in the design and ultimately you take care of the production of a new or a completely new machine, or is it a case that you try and match your product to the demand out there, but you want to keep control of your own IP? We do both.
We do have customers where we'll work with them step by step from a concept through to a full scale production machine. More typically, it's where we have existing machines and the customer wants to develop a new feature or a new capability within that. And we've got several examples working with the business at the moment where customers are asking for more and more data to be available from the machine, analysed, and helping them to maximise their throughputs and efficiencies. We've got a customer at the moment who's looking for predictive maintenance capabilities from the machine, so the machine to be able to say that the conditions are running out of the control parameters, you need to make an intervention within the next X hours in order to keep the efficiencies running. And that's working. That's the best type of partnership, because the customer's got a real need and we're there with our technical capabilities to match that need. And hopefully we can make that into a generic solution to offer to more customers.
Hence the 4.0, the advances of technology have to be applied to managing and accumulating the data as well as delivering the end product.
Yeah, well, one of the product innovations we talk about in our presentation pack that's available on the website is the new product introductions last year, and one of them was a new HMI, which is a human machine interface for the equipment, and that really is an important development. Why? Because it's the portal that will allow us to leverage for Industry 4.0 type solutions with our customers. So that gives us the basic foundation technology to be able to really talk to the customer about what their needs are and match those needs with future software developments.
Right, well, we might come back to product development as we look to the future a little bit more, but maybe we can now turn to Will and look at the full year results in a little more detail.
Okay, thanks Andy.
Right, good to see you again, Will, and lots of encouraging things to talk about. Maybe I'll just let you kick off and summarise some of the highlights from last year's numbers.
Sure. Okay, thank you, Andy. So I'll go through the highlights for 2018 for Mpac. So group sales, healthy increase, 9% increase in top line revenue to 58.3 million. So absolutely on track with our
10% growth, yeah.
Strategic intent. Absolutely hit the money there. In terms of order intake, 2018 was a tale of two halves. The first half we did experience some headwinds for order intake, as we spoke extensively about at the half year. The second half had a very strong profile in the development of order intake, which meant we ended the year with an order book of £40 million going into 2019. That's 16% increase in the prior year, so a very strong position for the group going into 2019. Underlying operating profit and underlying profit before tax came in at 1.4 million. That's in line with the market expectations after the revision in July of last year. So we're very satisfied with that. And closing net cash of 27 million at the end of the year means we've been able to secure the cash generated from the sale of the tobacco and instrumentation business to invest in future product development and to give us flexibility with our acquisition strategy.
Any opportunities that come along?
Absolutely. Earnings per share last year were 4.5p. Touching on the sales by sector, food and beverage still remains the biggest sector for revenue growth for our group. But in 2018 we actually saw a strong development in healthcare and consumer products, supported by new customer orders in the year. So that was very positive. Moving on to the development of sales by region and by product category. Very strong year in Americas, sales growth of above 20% in the year. And equally good year in EMEA, sales growth just over 14%. In Asia, a slight contraction, but our Asian business is limited to a relatively small number of customers. So therefore we are exposed to fluctuation of investment cycles from those customers.
Order flow could be quite lumpy, presumably, from people of their scale.
Absolutely.
So.
And then by product category, 2018 saw a 14% growth in original equipment, very much supported by the new product development roadmap that we've been able to roll out during 2018. So very strong performance. Services is a mixed result. We did experience a challenging first half of the year where a significant amount of our service resource was dedicated to the installation and execution of original equipment projects. But the second half again has been quite strong, and we saw 45% growth in half year 2 compared to half year 1 for services business. So the management of the group has invested time and effort and brought in resource to augment the service management team and the service capacity, and we're seeing the benefits of that in the second half of 2018. So we feel quite optimistic of how that will develop next year. Yeah. In the development of underlying operating profits, the legacy contracts are one large factor which has impacted significantly in 2018. We've took a £1.1 million additional cost in the year to close off on those projects. We absolutely feel now that we have reflected all of the cost into 2018, and we've got a very clean order book going forward now. So that really is legacy now. And in terms of the rest of the business, original equipment gross profit and margins remain strong. We're very satisfied with those. Service gross profit reflects the reduction in revenue, so the profit has been reduced to reflect that, but the margins within service are still positive and still strong. And then within sales and marketing and employment costs, there's some movement year on year reflecting activities with certain large trade shows. That generates a profit for the year of 1.4 million, in line with market expectations, and it gives us a good foundation to go forward. In terms of cash, as investors will know, we have a UK and a US pension scheme that we have to fund. That continues to be an ongoing commitment to the tune of about £3 million per year. So we ended the year with 27 million in cash after generating 2.2 million of positive cash inflows from EBIT, 1.9 million positive working capital movement, and then some investment in CapEx, reorganisation costs, tax, etc. The last comment to make is regarding our pension scheme. The last valuation of June 18 is still ongoing with the trustees. We expect to conclude on that cycle around the summer months of 2019. And
nobody can accuse them of rushing their decision.
No. Well, it's a collaborative process between the trustees and the company. And this year, in 2018, we've also had the impact of the GMP equalisation ruling.
Yeah.
7.3 million non-underlying, non-cash item, which is reflected in the income statement for the group.
Yeah. And presumably both of the US and the UK pension schemes have been closed to new entrants for quite a while.
Yeah, 2012 we closed the UK scheme, and we're obviously rolling out the legacy of deficit recovery payments until that scheme is fully funded.
Great. Well, thank you very much. We're looking forward to seeing that growth when you come back in 6 months' time.
Great, thank you, Andy.
Great, well, thank you very much for that, Will. Tony, back in the hot seat. Let's talk about the execution of the strategy. It's a 5-year plan, and you're probably only 2 years into it now, but have you had the need to make any adjustments to it?
No, the strategy, as you quite rightly say, we're 2 years into a 5-year strategy. There's 3 strong pillars to the strategy: going for growth, make service a business, and operational efficiencies. The going for growth objective, we're absolutely on track. As I think I commented earlier, the growth over the last 2 years in the business is circa 50%, so we're absolutely growing in the direction we need to do. Operational efficiency, on that side of it, we've gone through a process of introducing, a common business model across the company, the one Mpac business model, as we're calling it, which really brings the group together, operating as a single entity. And we're putting in place systems platforms for prospect management, project management. This year we will launch some engineering systems in Q2, which is the CAD and the product data management software, and next year we'll roll out an upgrade to our ERP system. So we're really satisfied with where they're going. The one area where we really need to refocus is on the make service a business, because we've been quite successful over the last couple of years on original equipment sales, new equipment into the market. The adverse effect of that, or impact, has been that our key resource and talent has been drawn into that and has not been available to support the service growth. Earlier 2018, we put in place a new management structure with a regional manager for service in EMEA, the Americas and Asia. And they've now been in place for some time and are getting really embedded and fully onboarded in the company. And we invested quite heavily in service technicians as well. So we saw growth in the second half of last year with service, and our challenge is to maintain that now and really start to unlock the potential of the new products, as I explained a little bit earlier, and the portal to get more Industry 4.0 applications into the marketplace to really drive that service and partnership with the customer throughout the life cycle of their investment.
Yes, and we also discussed innovation. We said we'd come back to it, and the HMI interface has already been discussed. A number of new products have been introduced in the course of the last 12 months, 18 months. How has the reception for them gone down?
Oh, really well. Innovation is the lifeblood, I think, of the company in terms of being able to come with new products on a regular basis and be at the forefront of the industry. We took a long, hard look at this in 2017. We made sure the roadmap was validated. We made sure we had resources in place. And the results of that was 4 new products that we launched last year at the Chicago exhibition, one of the major packaging machinery exhibitions in 2018. And that was met with an awful lot of positive reaction from the customers. And we won a significant contract in the US last year, and that was absolutely on the back of the new products that we launched. In fact, out of the 4 machines that we launched, 3 of them were part of the package that we managed to sell to the new customer. And their comment to me directly was, the reason why we chose you is because of your new product introductions. You're at the forefront of the technology, and we wanted to future-proof our investments to make sure that we were at the cutting edge. So it shows directly how important innovation is to driving growth and acquiring new customers. So we're very pleased with the performance last year. What we've got to do is do it all again in 2019.
There's no standing still.
It's like the second album syndrome.
Be like Led Zeppelin, have 10 of them, I'm sure. But in terms of those new products, what was their time in development? And again, looking forward, does that mean we might expect at least 1 new product per annum, or is it more a case of responding to clients' needs, and therefore you can't be certain just exactly what the pace of new development?
The first thing to say is that I was really pleasantly surprised by how responsive our organisation could be once we signed off the business case, if you like, the investment proposal. The development went extremely quickly, and there was an awful lot of enthusiasm around the company to get the product out to market and at the exhibition as soon as possible. So within 1 year, for a new configuration of a product is possible. We have new products being developed now that we're hoping to launch, one in Las Vegas later this year, which is an important exhibition for packaging machinery, and then next year in Germany is the biannual major packaging exhibition for Europe, and we've got 2 or 3 new products that we want to launch there. So I'm hoping and planning around at least 1, if not 2 or 3 important product launches per year to really keep that product pipeline vibrant.
Sounds encouraging. And looking at the again, coming back to the broader strategy, the target returns, both the top and the bottom line of 10% growth in revenues, 10% return on sales. Is that a target that you are comfortable in hitting organically, or do you think there is scope for bolt-on acquisitions, acquisition of IP going forward? And if so, would that merely accelerate hitting those targets rather than the targets being dependent on it?
Well, I think as you've seen over the last couple of years, the growth target of 10% compound average, we're meeting at the moment. We're doing that organically. We're doing that within our own resources. So we're comfortable with that going forward as a target, and we're on track to achieve that. The improving return on sales, you can see that if you analyse the financial figures for the last 12 months and take out the one-off items, the legacy contracts specifically, that we've made really good progress on our operational efficiencies, and with the platforms that we're putting in place and the other strategic measures, we're confident that the return on sales will improve year on year. Acquisitions are really important to accelerate the scale and to have more of the full solution. So our target in acquisitions is, the sweet spot would be pharmaceutical, healthcare, primary packaging. Now, if we could find a suitable target that fits that criteria, that would absolutely enable us to accelerate our growth by offering the full solutions in those markets. So that would be incremental on top. But I think we're comfortable with our organic growth plan, achieving the targets, and acquisitions will be on top and in addition.
Well, I don't want to tempt fate, but it does sound as if the group is well set. As Will mentioned, the impact of the legacy challenges last year was over £1 million, which is not going to happen again. I would certainly not expect you to make forecasts, but there are analyst notes out, including one from our own man Paul Hill, which have got profit forecasts of around £3.5 million for this year, compared to the 1.4 that you've just reported. So that sounds like good growth and good news for the shareholders as well. So Can I thank both of you very much for that transparency and update. As Tony mentioned, the full deck of slides that have been referred to is available on the Mpac website, and Paul Hill's latest notes and forecasts are available on the Equity Development website. Thank you.
Thank you, Andy.